Let's say you have invented a better mousetrap, and you've probably all heard the saying, invent a better mousetrap and the world will beat a path to your door. So you do make a better mousetrap and the world beats a path to your door. Well, after this happens, you realize that you need some funds to invest in some capital goods. You need a factory. You need to build this thing on a large scale. So where'd you get the money? Well, here's you. And on the other side of the town, there's Tom. Tom spends less than he makes. And he puts the excess cash under his mattress. And he's looking for a productive use for that cash. He's looking for a great investment. So, how do you and Tom get together? How do you find each other? He's got money to invest. You've got a great investment. If you only knew about each other. Well, I guess you could place an ad in the paper. Hey, build a better mousetrap, need money. You could go door to door and say, hey, I've got this invention, you want to invest in my company? Well, you could. You could get on the phone, start calling people. Well, if that's how it was to be done, you could see a lot of inventions would never make it to the market. And our standard of living would really suffer because productivity would not be growing. Yeah, we know how to make the stuff, invent the stuff. Of course, on the other hand, that would kind of lessen the incentive to invent stuff, wouldn't it? If you invented this great thing and then knowing in advance that you're not going to be able to get the money to market it or to build it or whatever, you probably wouldn't even start. So, what we need is a way for you and Tom to get together, to find each other. And that thing that does that is called the financial system. The financial system are institutions that match one person's savings, that match one person's savings with another person's investment. Okay, in this example, we have you with an investment. You want to build a factory. That's an investment in capital goods. Tom's got some savings under his mattress. The financial system, institutions that bring you and Tom together. All wealthy economies have a well-developed financial system. Without that, nothing much will happen. Capital goods are very expensive. You just don't save up your money for capital goods. It means you need to get other people involved and their savings involved to be able to build factories and so on. So, as discussed earlier in the course, countries that invest more in capital goods have more growth in their economies. Here is the production possibilities curve. Here's country A. Country A chooses to be at this point. country B chooses to be at this point, which economy is going to have more growth? Well, A has this much capital goods. B has this much capital goods. B has more consumption. Hey, more partying, more fun. A has less. But A is going to experience more growth again. So, in this chapter, we're going to discuss the financial system. Just take a look at how it directs savings and investment. And, features of the financial system. We'll look at direct finance. Then we're going to look at indirect finance and some of the financial instruments and institutions involved. And then we're going to look at how the financial system directs savings to investment. And we're going to use a couple of equations to map things out, then some supply and demand curves to see how all this works. So let's start with direct finance. Direct finance is when a company goes directly to the public for the money it needs for capital investment. Here's households here. This is you and me, sitting at home with our money under our mattress. Now, what we can do, here's the business firm. We can send our savings over to the firm, and then they are going to take our savings and purchase a capital good. Machines, factories, whatnot. Okay? There we have it. Well, when we send our savings over to the firm, we get something back. If we lend the savings to the firm, we're going to get a bond back. Okay, we've lent money to the firm, and a bond is simply a contract, a loan. The bond stipulates the terms of repayment, the timing of repayment, the interest rate, when interest payments are made, and when the bond matures, when it's over, when the whole loan is paid back. Bonds can be short-term or long-term. There's all kinds of arrangements here. Short-term corporate bonds are usually called, less than a year, called commercial paper. And then there are notes that are intermediate term, and then bonds are typically referred to those as longer term. But they're all just bonds, okay? It's just a loan, the generic term bonds, and there's some more information in there in your textbook that give you some more of the features. Now, government also borrows money here. They issue bonds. When the government spends more money than they bring in through taxation, where do they get the rest of the money? They borrow it. And they borrow it by issuing treasury bills, treasury notes, treasury bonds. Okay. So, before I get all involved in bonds, okay, we forgot to put that in there. The firm is looking for a return on investment. Okay, that's the bottom line here. So we send our savings over to the firm. We get a bond back. Going to pay us interest. The firm takes that savings, purchases a capital good from which they get some kind of return on that investment. And that return on that investment has to be bigger than the interest rate they pay on the bond, or this isn't going to work. Okay, so let's say this is 12% and this is 8%. There you go, that works. If this is 12% and this turns out to be 8%, that does not work for them. So they certainly don't want that to happen. Well, let's spend a minute and talk about different bonds, various bonds in the bond market. Start with government bonds, federal government bonds. Well, short term, less than a year, they're called Treasury bills, usually 13 weeks. Those are considered the safest place you can put your money. They're backed by the full faith and credit of the federal government, and they're short term, so there's very little what we call interest rate risk. I guess a little bit about that later. And so that is considered in finance the risk-free rate. In finance, when you're looking at different investments and so on, you're comparing it to a risk-free rate. And that's as risk-free as you can get, his Treasury bills. And then there's intermediate term, 1 to 5 years. Okay, those are usually called, there's a bunch of them. Treasury notes typically means intermediate term, 1 to 5 years or so. And then 10 years and over, Treasury bonds, long term. Treasury bonds can go up to 30 years. And so if interest rates are really low and they want to lock in a really good rate, they will borrow long term. 30 years is a long time to lock in money, and if they get the chance, they certainly want to do so. The government would want to do that. Well, corporate bonds are not risk-free, and ratings agencies rate these bonds, rate these companies, and according to how well the companies run, their financial fitness, and so forth. And AAA, there are different ratings agencies, Moody's, Standard & Poor's. Standard & Poor's rates them AAA as the very highest, the very best rating. So those bonds, since they have the least risk because they come from the best companies, those interest rates won't be much higher than, say, a Treasury bond. So a AAA rated corporate bond will be a little bit higher than a Treasury bond because there's more risk to a company than there is the federal government. You've got the full faith and credit of the company, but the full faith and credit of the whole government and all their taxing power and authority is still a little bit safer. So you typically will see these interest rates a little lower than these interest rates. However, these keep on going down, 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 down. So we've got AA, A, BBB, and so on. And when you get clear down to somewhere in the D range, or CC, depends, but when you get around D, in that ballpark, that is what is called a junk bond. A junk bond is just what it says. It's junk. Why is it junk? Because it's high risk. Now, you will see these are not called junk bonds. You'll see in the investment world, they will market themselves as high yield bonds. High yield. See, doesn't that sound better? High yield. Why are they high yield? Why are they paying that high interest rate? Well, they need to pay a high interest rate to induce people to put their money into them, to buy them, because they're high risk. The only way you can sell a junk bond is if it has a high rate. They don't pay high rates because they're nice. They pay high rates because they have to induce people to take the risk. So if you want to buy a junk bond, fine. Just make sure it's not money you can't afford to lose. Okay, the worst thing you could ever do is put all your money into something like that. Well, and there are people, some of the biggest mistakes people make. When you're young, the biggest mistake you make is you don't spend less than you earn. That's the biggest mistake. As you move along, those who do spend less than they earn, which means they have some savings, probably the biggest mistake they make is they don't understand the relationship between risk and return, which we'll talk a little bit more later. They think it's smart investing to put all their money. They say, well, why? I could get 15%. Why wouldn't I put all my savings in an investment getting 15%? Why would I put some of it in? Why would I put any of it in an investment getting 5%? Like in treasury bills. Why would I do that? That's just dumb. Of course I put all my money getting 15%. Well, of course they lose it all. Because the reason it was getting 15%, it was high risk. Okay. And then, of course, while I'm on a roll, probably the biggest mistake when people get older is they retire too soon and they take Social Security too soon. Okay. This retirement business at age 65 is so antiquated. Back in the 30s, when people retired at 65 and died at 67, that worked out. They were retired for 2 years. Do people die at 67? Well, yeah, some, but on average, I'm talking, they live in their 80s. So, yeah, to retire at 65 is the biggest risk these days is to outlive your money, and that's a big mistake that too many people are making. They retire too young, and then they run out of money. Anyway, back to the class here. I think I got a little sidetracked there, just a little bit of, but anyway, yeah, don't put all your money into high risk, high return investments. Yeah, the high return's great, but the risk, you diversify. Okay. There's a lot to cover in here, and there's only so much I can do in one chapter. So anyway, I will try not to get sidetracked. So, and then there are municipal bonds. Municipal bonds are issued by school districts, towns, cities, and municipalities. And the nice thing about these, and hold on a second, first and foremost, these are not risk-free. Okay, this is not like federal government bonds where they will pay. Okay, municipal bonds have defaulted. So don't make the mistake of thinking, well, it's a government bond. Well, yeah, it is, but they can and do default. So you've got to see what the rating is on these. They AAA, they BBB. Where are they on the scale? Municipalities are not all equal. But the nice thing about them, if you find a good municipal bond, the really nice, especially in your state. So let's say New York State, of course. The interest is not taxed on the federal level with municipal bonds. So any interest you get is tax-free. And if the municipal bond is from your state, if it's a New York State municipal bond, the state doesn't tax the interest either. So as a result of this non-taxation of interest, this is designed to help municipalities raise funds at a lower cost. So interest rates will be lower on municipal bonds compared to bonds of similar term to maturity and similar risk. Municipal bonds will have a lower interest rate, but it's tax-free. So what you've got to do to determine which one's the best is convert the municipal bonds into an equivalent pre-tax return, or convert the bond, the corporate bond, into a equivalent after-tax return to see which is best. If you're in a very high tax bracket, these are probably the way to go. Very popular because they're tax free. Well, you've got a bunch of different kinds of municipal bonds. Again, a lot of the characteristics maybe I'll leave for the textbook. You've got industrial revenue bonds. You've got general obligation bonds. You've got municipalities that underwrite like football stadiums, that kind of thing, so that they can borrow the money cheaper to help bring a football team into town, that kind of thing. But again, some of these projects, if that project fails, the bond defaults. So you got to watch out. Well, okay. Here's a little thing we're going to see is in the chapter that is worth noting. And this is usually drawn with Treasury bill rates. So we've got the Treasury bill rate here. And you've got the time to maturity here. And you can draw one of these for any bond over here, but typically it's Treasury bonds or Treasury bills. And what they want to look at is the relationship. What this tells us, and by the way, this has a name. This is called the yield curve, and it is typically upward sloping, meaning that very short-term time to maturity, less than a year, Treasury bills, will have a lower interest rate. Well, let me just put in a number. 2, 3, 4, 5. Okay. So, Treasury bills will have a low rate because they're short-term. There's very little risk involved that interest rates will rise before it matures, that kind of thing. Just a quick and dirty explanation of something called interest rate risk. There are two types of risks involved with bonds. There's default risk and interest rate risk. Interest rate risk is the risk that bond prices will fall. Okay, if bond prices fall and you sell, you're going to lose money. If you need the money at that time, if you sell it before it matures, let's say a bond matures in 10 years and you decide you need your money in 7 years. Got to have your money. You can sell your bond on the open market, just like you would a stock. But bond prices have fallen, which means interest rates have gone up. If market rates have gone up, that makes your bond, let's say you have a 3% bond and interest rates have gone up to 5%. Who's going to want to buy your 3% bond when they can get a new bond for 5%? Nobody's going to want it, right? So you're sitting here with this bond with a 3% interest rate. The only way you're going to be able to sell that is if you sell it at a lower price. So the price will fall. That's what's called interest rate risk. If interest rates go up, your bond price will fall, and that is a risk. That's a bigger risk with longer maturity bonds. And to compensate for that risk, they have a higher interest rate. Risk and return. It's not that we won't take risk, we just have to be compensated for it. Well, and then there's default risk. But here we're talking about interest rate risk. That's why this yield curve tends to slope up. Longer term bonds have more risk. And I suppose there's more default risk when we're looking at corporate bonds, because the future is uncertain. So, and the other risk is default risk. That's just the risk that the company's going to go bankrupt and won't be able to pay. Now, there's no default risk with treasury bonds, but there's virtually no interest rate risk with these short-term treasuries, which are called treasury bills. But longer term, out here, there is some default risk. Interest rate risk. And again, even with a treasury bill, a treasury note, and treasury bond, you're going to see this upward sloping yield curve. The longer time we go out, the higher the interest rate savers in bonds are going to require, or they won't buy it. People must be compensated for taking risks. They don't take risks for free. Okay, now if we go back up here, another way firms can get savings from you is, instead of bonds, I'll put this in red so you can see, they can issue shares of stock. Same thing goes on. Everything else is the same, except for now, when you send your savings over to the firm, they're giving you shares of stock instead of a bond. Now, when you get a bond, they're borrowing money from you, money that needs to be repaid. But when it's stock, what you're buying when you buy stock is a share of ownership. Stock is ownership. When you buy a share of stock, you own the firm. So if there's 100 shares of stock outstanding and you own 80 shares, you own 80% of the company. But stocks have different characteristics than bonds. So let's look at some of the differences between stocks and bonds. Let's go with stock over here. Stock is, again, that you own the company. And with a bond, you're simply loaning money to the company. Okay, that's the first, foremost difference. But what does that imply? Well, what that implies is, you get dividends. You're an owner. You receive dividends. And dividends are simply money that's paid out. It's profit, sharing in the profits of the company. And with bonds, you get interest. Now, a bond, interest is in the contract. The bond states interest. So much interest will be paid at certain intervals and so on. With a stock, there's no guarantee you're ever going to pay or receive a dividend, ever. Okay, so that's an important difference. And if the firm goes belly up, the stockholders are the last in line to get anything. Anything. If the company goes belly up, liquidate it, the bondholders are in line ahead, okay, of the stockholders. So, as an owner, you bear the risks of ownership. You're an owner. You may not get a dividend. Even if profits are positive, you may not get a dividend. The company may decide to plow those profits back into the project just use that as a way of financing capital goods. If they go belly up, you're last. You own the company. You've got to pay your creditors. One of those creditors are the bondholders. So, based on those characteristics, which would you say is more risky overall? Stocks or bonds? Well, it's pretty clear that stocks are riskier, and as such, require a higher rate of return from investors, savers. Okay, I've got to remember to talk about the difference between saving and investment here. But I think I'm going to wrap this up. We've gone 30 minutes. And we'll call it quits here and then come back with some rates of return. And I will show you that the market certainly does consider stocks riskier than bonds.